It's really easy to make investing mistakes, especially when you're a beginner, and mostly by those starting investing in stocks. My goal is to teach you how to play safe and how to avoid the most common beginner investing mistakes. Please remember, this is not financial advice. Let's dive in. Number 1, never borrow money to invest. Always remember that investment returns aren't guaranteed, particularly in the short term. You would end up paying more for interest that you lend and stuck in a never-ending cycle of more debt if you borrow money for investment purposes. Similarly, never use the money that is meant for spending on paying down current debt. Debt reduction comes ahead of investing. Once this is under control, particularly with your credit cards, you can put the after-debt excess in numerous investment vehicles. Number 2, get yourself ready for volatility. Unless you invest all your savings into CDs, certificates of deposit, or money market funds, you need to always expect some variability in terms of your returns. The best way is to always do your research and play safe. One best way to see how volatile a particular market or stock is about the broader equities market is its beta. The S&P 500 has a beta of 1.0. From here, you can estimate a stock with a beta above 1 shows that it is more volatile than the broad market. On the other side, a beta that is less than 1 shows that the equity is less volatile. For instance, you need to keep some of your extra money in easy-to-reach vehicles like savings, checking, or money market mutual funds at a brokerage firm. This enables you to leave your best long-term investment stocks in your portfolio and grow their returns with time. Afterward, some part of your extra investment assets can be put in CDs. You don't need to put all your extra money into stock market funds. This enables you for a no to low risk way to grow your money. And rates for that are attractive right now, with more than a few one-year CD rates of more than 5%. Money market accounts also make folk a safe place to store their money and get a decent rate of return. Some of the best money market accounts right now are offering yields over 5%. Number 3, always have some savings and don't invest that money. Investing is volatile, and we can never predict what will happen next. So, never utilize emergency funds as they are important, and you may need them for a reason. Plus, always leave enough cash to tackle an emergency or while you are being let go from work. You can create high-yield savings accounts and put all your money inside them, or even your checking account that you can access easily. Most ideally, you can save money to cover up for at least 3 to 6 months of living expenses. By not putting this money in the stock market, it will not be subject to any kind of volatility or sudden price drops. Additionally, emergency funds should not be put in a CD, certificate of deposit, or similar account where there are withdrawal penalties. Number 4, study all your investing options. Still, the best way to grow your money with time is in the stock market. If you're a beginner, then your hard-earned cash in the stock market is best handled by first buying mutual funds, particularly no-load mutual funds that don't have a commission or sales charge, and/or low-cost ETFs, exchange-traded funds. These are baskets of equities that spread the risk around, and investing in these first will let you grow a feel for the intricacies of the equities market. Only after doing that for a short period can you venture out and invest in individual stocks. The best outcome over time for both beginning investors and long-time market participants is to buy stocks with larger market capitalizations that pay regular dividends. A great example of one of the best dividend stocks is Coca-Cola, which has a market cap of nearly $260 billion. Besides, it has paid out and increased its dividends yearly for the past 62 years. Number 5, trying to make a quick killing. Look, we all want to see our investments grow fast. The temptation to make a quick killing on your first few investments is real, but trust me, it's a trap. The odds just aren't in your favor, especially if you're dealing with cheap, low-priced stocks. I'm talking about those stocks trading under $5 or $10 per share, usually without dividends. Now, here's where things get risky. When stocks are this cheap, they tend to lack liquidity, meaning there aren't many buyers or sellers. This makes them the perfect vehicle for what's called a pump and dump scheme. You've probably heard of it, right? The idea is simple. Stock promoters hype up a stock, artificially driving up the price. Once it climbs high enough, they sell off their shares, leaving you stuck with a plummeting stock and, well, poor returns or even losses. Remember the Wolf of Wall Street? Yeah, it's like that. Avoid falling for these schemes. Number 6. Penny stocks equals penny returns. Penny stocks sound exciting because, well, they're cheap. But let me give it to you straight. These stocks are cheap for a reason. Companies with super low earnings often have incredibly high price-to-earnings ratios. Anything over 30x is a red flag. You're essentially betting on companies that aren't making enough money to justify their stock price. Not exactly a solid investment strategy, right? Another big mistake? Investing without a plan. You don't need to overcomplicate things, but having a basic roadmap is essential. When you have a plan, you're not just chasing quick profits. You're building a portfolio that can weather market downturns and come out stronger in the long run. When the market inevitably dips, and trust me, it will, a solid plan will keep you grounded. You won't panic sell at the worst possible moment. Instead, you'll stay calm, confident that your strategy will lead to long-term gains. Number 7, long-term thinking greater than short-term gains. And finally, the biggest mistake beginners make? Focusing on short-term gains instead of thinking long-term. Here's the deal. Investing is a marathon, not a sprint. Building wealth takes time. The ups and downs of the market are natural, but those who stay the course and stick to their strategy often come out on top. All right, there you have it. 7 big mistakes to avoid when you're just starting your investment journey. Remember, it's all about patience, research, and having a solid plan. If you found this helpful, give the video a thumbs up, subscribe, and let me know in the comments what investing tips you'd like to hear next.